Welcome to the Opening Bell Report.
Okay, let's just check the calendar here. It is January 30th, 2026, and if you've been watching the stock market, specifically the tech giants, you might be scratching your head a little bit. We're looking at Netflix ticker NFLX, and it is trading at $83.16. That is hovering right near its 52-week low.
It's definitely a number that makes you pause. I mean,
Yeah.
for a company that was the absolute poster child of the last decade's bull run, seeing it languish in the low 80s feels,
Wrong.
or at least jarring.
Exactly. It feels like a glitch in the matrix.
Mhm.
And that's the central question we're tackling today. When you look at a giant like Netflix sitting at these levels, what are you actually seeing? Is this a dying star that's burning out and has been of the tech world? Or is this a bargain bin opportunity of a lifetime?
It's the classic investor's dilemma, isn't it? Are you catching a falling knife, or are you being smart and buying the dip when everyone else is panicking?
So to help us figure that out, we're diving into a really comprehensive valuation deep dive analysis report that just dropped. And the mission of this deep dive is pretty simple. We need to answer unequivocally, is Netflix finally cheap? Because cheap, that can be a very dangerous word in investing.
Oh, it can be. Sometimes things are cheap for a very good reason. But just to give you the spoiler alert up front, this analysis report has a pretty high conviction answer. It argues that, yes, Netflix is cheap, but not just cheap. It argues the market has fundamentally misunderstood where the company is in its life cycle.
Okay, and this gets to the absolute core theme of the report. It uses a phrase I think perfectly captures the mood: the maturity discount. Now, be honest with me. Usually when I hear the word maturity applied to a stock, it sounds like a polite way of saying old, boring, and slow.
It feels like a backhanded compliment, doesn't it? Like telling someone they have a great personality.
Exactly. It sounds like the party is over.
And that is exactly the mistake the analysis says the market is making right now. The maturity discount here refers to the fact that investors are punishing the stock because it's no longer that, reckless teenager driving 100 miles an hour.
Mhm.
Back in the 2010s, they were growing revenue at 30, even 40% a year. It was hyperspeed.
And today?
Today, that revenue growth has decelerated to about 11 to 13%.
Okay, so that's a massive drop. I can see why the market is nervous. If you buy a race car, you expect it to race. If it starts driving like a minivan, you're going to be disappointed.
Right. But here's the insight. The market has repriced Netflix from a tech disruptor, which gets a huge premium valuation, to a media utility. They're treating it like the electric company. Reliable, but boring. And the analysis suggests this repricing has swung the pendulum way too far. It's an overcorrection.
Right. Massive investing mistakes happen when the market changes a label, but the business fundamentals don't actually match that new label.
Precisely.
Okay, so let's look at those fundamentals. If we're claiming the market is wrong, we need the receipts. The report calls this segment the valuation disconnect. Break down the numbers for us. Why is $83.16 considered cheap?
The first place we have to look is the price to earnings ratio, or PE. This is, the price you pay for every dollar of earnings the company generates.
Mm-hmm.
Historically, over the last 5 years, Netflix has traded at an average PE of about 45 to 50 times earnings.
Which is high. That is a premium price tag. That's what you pay for the cool kid on the block.
It is. That is what you pay for hypergrowth. But right now, the trailing 12-month PE is sitting at 32.9x.
Whoa. So we're talking about a significant drop.
It's a massive drop. That's
Yeah.
roughly a 30% discount to its own historical average. The market is effectively pricing Netflix as if innovation is dead, as if it's just a legacy cable company now.
But I want to play devil's advocate here, because I know what some listeners are thinking. A PE of 33 isn't exactly bargain basement in the general market. Banks trade at like 10x. Ford and GM trade at single digits. Is 33 actually low for a tech company? Or are we just anchored to those crazy high numbers from the past?
That is a fair question, and this is where it gets really interesting. You can't just look at PE in a vacuum. You have to look at what you're getting for that price. That's where the PEG ratio comes in, the price earnings to growth ratio. It's the great equalizer in valuation.
I love the PEG ratio. It keeps us honest. But for everyone who doesn't have a financial calculator handy, walk us through the logic. Why do we use this?
Think of it this way. If you pay 30 times earnings for a company that isn't growing at all, you're overpaying. But if you pay 30 times earnings for a company that's growing its profits by 30% a year, you're probably getting a deal. The PEG just formalizes that.
So it tells you how much you're paying for each unit of growth.
Exactly. So you take that PE of 33 and you divide it by the earnings per share growth rate. Now, for Netflix, that earnings growth is currently a really robust 27.8%.
Wait, hold on. Almost 28% earnings growth. I thought you just told me revenue growth slowed down to like 11%.
Revenue did slow, but earnings are exploding, and we'll get to why those two numbers are so different in a minute. That is the secret sauce. But first, let's finish the math. When you divide the PE of 33 by that growth rate of 27.8, you get a PEG ratio of 1.18.
Okay, 1.18. Now give us the context. Is that good, bad, average?
The general rule of thumb on Wall Street is that a PEG near 1.0 is fair value. If you can find a high-quality growth stock with a PEG under 1.0, you back up the truck and buy as much as you can. But finding a tech monopoly, which Netflix arguably is creating under 1.5, is rare. So sitting at 1.18, that's objectively cheap.
So adjusted for its massive earnings growth, the stock is on sale.
Exactly. The report really emphasizes this point. The market sees the PE of 33 and thinks expensive, but they're missing the 26+% earnings growth powering it. It's a mismatch.
And before we move off the price action, the report mentions some technicals too. It says the stock is sitting at institutional support. What does that mean in plain English?
It means we're at that $80 to $82 range. This is a level where big institutional buyers, pension funds, mutual funds, have historically stepped in to buy. The technical indicators suggest seller exhaustion.
Seller exhaustion. I like that term. It sounds like everyone is just tired of dumping the stock.
Basically, yes. Everyone who wanted to panic sell because the growth slowed has already sold. They're out. The risk-reward here looks heavily skewed in your favor.
Okay, I want to pause you there. The math looks good. The chart looks good. But I have to play the cynic here.
Please do. That's your job.
Because we've all seen cheap stocks that just keep getting cheaper. It's the classic value trap. You think you're buying a bargain, but you're actually buying a company that's slowly dying. I mean, Blockbuster looked cheap in 2010, right? BlackBerry looked cheap when the iPhone came out.
That is the nightmare scenario.
Exactly. So how do we know this isn't that? How do we know Netflix isn't just the next dinosaur waiting for the meteor? Is the business actually deteriorating?
And this is the most critical pivot in the entire analysis. If the business was deteriorating, a low PE would absolutely be a trap. But the report argues Netflix is doing the exact opposite. It's not dying, it's transitioning. And the proof is in the cash flow.
The cash flow spigot. I saw that header in the report.
It's the strongest argument they have. Think back to 2021. What was the narrative around Netflix?
Well, we're spending money like crazy. Burn, burn, burn.
Exactly. Negative cash flow. They were borrowing billions of dollars to build Stranger Things and The Crown. They were burning cash to build their library. Investors were worried they'd run out of money before they ran out of show ideas. But look at the reality now in 2026.
What's the number?
They're generating $9.5 billion in free cash flow.
Wait, $9.5 billion with a B?
With a B. That is a staggering turnaround. They've gone from a cash incinerator to a cash printing press.
So what does that mean for the company if they have $9.5 billion just sitting around?
It means they're self-sufficient. This is the maturity part of the discount, but in a good way. They no longer need to borrow money to make shows. They can self-fund all their content. And more importantly for investors, they can use that cash to buy back shares.
Which boosts the earnings per share.
Precisely. That is why earnings are growing at 28%, even though revenue is only growing at 11%. They're shrinking the share count and becoming more efficient. This is the definition of a cash cow.
And speaking of efficiency, the report highlighted another metric that made my eyes pop. The return on equity, or ROE.
Well, this is the quality metric. Their ROE is 41.3%.
Can you translate that for us? What does 41.3% actually mean in the real world?
Okay, imagine a machine. You put $1 of equity into the slot at the top. A year later, the machine spits out 41 cents in profit. That's an ROE of 41%.
That's a pretty good machine.
It's a phenomenal machine. Most companies struggle to get to 15 or 20%. A 41% ROE proves their business model scales beautifully. It shows management is incredibly efficient at using shareholder money to generate returns.
So we've established they're cheap, and we've established they're printing money, but they aren't the only game in town anymore. We have to talk about the streaming wars.
Of course. You can't talk Netflix without talking competition.
Right. Why on earth would I pay 33 times earnings for Netflix when I could go buy Disney or Warner Bros. Discovery? Disney has the Avengers, Star Wars, Pixar. I mean, culturally, they are beasts. Why isn't their stock the better buy?
That is the landscape question. And the report tackles this with a section called the moat. And here's the kicker. The moat isn't just about having good shows. It's about margins.
It's a margin battle. Let's compare them.
So Netflix has an operating margin of 29.5%. That is dangerously close to software company territory. Now look at the competition. Disney's direct-to-consumer business, they're hovering around 10 to 12%.
Ouch. That is a massive gap.
It gets worse. Warner Bros. Discovery is struggling in the low single digits, battling just to break even on streaming some quarters.
Wait, hold on. Disney's been around for 100 years. How is it possible that Netflix is 3 times more profitable per dollar than Disney's streaming business?
It comes down to scale and sunk costs. Think about it. Netflix has over 280 million subscribers. When they spend $100 million on a new season of Stranger Things, That cost is spread out over that massive base. It costs them pennies per user.
Whereas
Disney and Warner Bros. Are still playing catch-up. They're spending heavily to acquire customers, and they don't have the same volume of subscribers to absorb those content costs yet.
So Netflix has already paid the cover charge, and now they're just enjoying the party.
Exactly. They've achieved what we call operating leverage. Every new subscriber they add now is almost pure profit because the content is already paid for. That is the aha moment the analysis tries to drive home. When you buy Netflix, you aren't paying for a struggling runner-up. You're paying for the market leader who has already solved the puzzle.
It's like buying the person who won the marathon while everyone else is still at mile 15.
And not just won the marathon, but did it without breaking a sweat.
Okay, I am feeling pretty convinced, but my job is to be skeptical. Let's look at the downsides. The report has a bear case section. Why is the market scared? Why is the stock down 38% from its highs? There has to be a reason other than just misunderstanding.
There are legitimate risks, and the report doesn't shy away from them. The first one is saturation.
We've all got a Netflix account, right? Or we're stealing our ex's password.
Or your parents' password.
Yeah.
Exactly. The North American subscriber base is nearly tapped out. There just aren't that many households left to sign up. This means future growth has to come from developing markets places like India, Southeast Asia, parts of Africa.
And the problem there is
They pay less. The average revenue per user, or ARPU, is much lower in those regions. So adding 1 million subscribers in India doesn't move the needle on revenue the same way adding 1 million in the US does. The market's worried that Netflix is running out of high-value humans to sign up.
that makes sense. What about the ads? I know they launched that ad-supported tier a while back.
That is the second big uncertainty. The market is still skeptical about the execution there. The fear is cannibalization.
Cannibalization.
Right. The fear is that people who are currently paying $20 a month to the premium plan will just downgrade to the $7 plan with ads to save money. If Netflix doesn't make enough money from the ads to cover that gap, they actually lose revenue. It's a very delicate balancing act.
And if they don't get that mix right, margins could take a hit.
Right. And speaking of margins, the third risk is the content wars.
I thought we said they won the war.
They won the profitability war, but the spending war is always a threat. If Amazon or Apple decides to just dump unlimited money into content to grab market share, I mean, remember, Apple doesn't need to make a profit on TV shows. They just want to sell iPhones. If that happens, Netflix might be forced to increase their content spend back above $17 billion a year just to keep up.
And if spending goes up, those beautiful 29.5% margins go down.
Exactly. It's a competitive pressure that never fully goes away.
So saturation, ad execution risks, and the threat of a spending spiral. Those are real risks. But the report concludes with a buy rating, so clearly they think the pros outweigh the cons.
They do. They have a 12-month price target of $115.
Right.
That implies about a 38% upside from where we are today.
That's a healthy return.
It is. But the most compelling part of their conclusion, and I think this is the part that will stick with listeners, is the comparison they make to another tech giant.
You mean the Apple comparison?
Yes. But to really get this, we have to hop in a time machine.
Okay, set the dial. Where are we going?
We are going back to 2016.
Take us there. What was the mood?
It was gloomy. If you looked at Apple ticker AAPL in 2016, it was trading at a PE of just 12x.
12. For Apple, that sounds insane today. You can't even buy a regional bank for 12 times earnings now.
It does now. But back then, the narrative was remarkably similar to Netflix today. The headlines were all, iPhone growth is over. The smartphone market is saturated. Where's the innovation? People genuinely thought Apple was dead money.
I remember that. People were saying Tim Cook was just a manager, not a visionary. They missed Steve Jobs.
Precisely. Everyone was obsessed with what's the next device. But the market was missing the pivot. Apple was transitioning from a hyper-growth hardware startup into a cash-generating empire. They were building the services ecosystem. They were buying back stock. They were maturing.
And if you had bought Apple in 2016 amidst all that boring talk,
You would be incredibly wealthy today. The report argues Netflix is at that exact inflection point. It has graduated from growth to quality. The market is confused because it's looking for the flashy subscriber numbers, the equivalent of iPhone sales, and it's missing the mountain of cash they are sitting on.
that's a powerful parallel. It's about shifting your mindset from how fast are they running to how much muscle have they built.
Exactly. When you look at the $9.5 billion in free cash flow, the buybacks, the dominant position, this isn't a company fighting for survival like Blockbuster was. It's a company enjoying the spoils of victory.
So let's recap the journey here. We started with a stock that looked beaten down at 83 bucks. We found a valuation that's historically cheap with a PE of 33 and a PEG ratio of 1.18. We then discovered a massive pivot to positive cash flow that puts them in a league of their own compared to Disney and Warner Bros.
And we identified that while there are risks with saturation, the maturity discount the market has applied is likely a huge overreaction.
It really does sound like the market is having an identity crisis about Netflix, and savvy investors might be able to profit from that confusion.
That is usually where the best opportunities are found, in the gap between perception and reality.
So here's the final thought I want to leave you with today. We often get addicted to the next big thing in investing. We want the rocket ship, we want the disruption. But if Netflix has successfully transitioned from a disruptor to the establishment, kind of like a utility company that just prints money, should we start looking for the next explosion in subscribers?
It raises a fascinating question. At what point does boring become the most profitable quality a stock can have? If boring means predictable high-margin cash flow that funds its own growth, then maybe boring is exactly what you should be looking for in a volatile market.
A safety play disguised as a tech stock.
I like it. Well, that wraps up our deep dive into the Netflix valuation report. We hope this helps you make sense of the numbers next time you scroll through your watch list.
Always a pleasure to dig into the data.
Thanks for listening and happy investing.
Don't forget to like, share, and subscribe for more.